The year 1637, Amsterdam. A single piece of paper trades hands in a crowded exchange hall, not a treaty, not a royal decree, a share certificate, the Dutch East India Company, the VOC. That paper costs more than a mansion overlooking Amsterdam's canals. The man who buys it believes he owns a fragment of an empire that spans 3 oceans. He does, but empires built on paper burn faster than anyone imagines. 40 warships patrol Asian waters under the VOC banner. 150 merchant vessels carry nutmeg, cloves, and pepper worth more than gold. From the Cape of Good Hope to the shores of Japan, the company controls trade routes that built the richest nation on earth. The Dutch Republic dominates global commerce not through kings or conquest alone, but through something revolutionary. The world's first publicly traded corporation. Investors flood the Amsterdam Stock Exchange. They watch share prices climb. They collect dividends that would make modern hedge funds weep with envy. 40% annual returns, year after year. The money flows like the tide. But in the ledgers hidden in VOC headquarters, accountants record different numbers. Debt accumulates in columns of ink that never see daylight. Ships rot in Asian harbors while dividends get paid from borrowed gold. On Indonesian islands, entire populations vanish to maintain monopolies that fuel those dividends. 162 years later, that same company, the mightiest commercial empire in human history, collapses into bankruptcy so complete that shareholders receive nothing. 2.5 centuries of dominance erased. The first Megacorporation becomes the first too-big-to-fail disaster. This is the story of how merchants became conquerors, how shares became weapons, how a company invented modern capitalism and then proved why unchecked power always devours itself. Welcome to the rise and fall of the VOC. Portugal controls the gateway to Asian riches. Spanish ships block Atlantic routes. For Dutch merchants in 1600, reaching the Spice Islands means navigating around Africa, dodging Portuguese warships, and surviving storms that swallow entire expeditions. Individual Dutch traders mount desperate voyages. They mortgage everything. They recruit sailors with promises of fortune. Most fail. Those who succeed return with cargo holds packed with nutmeg and pepper that sell for 20 times their cost. But the next voyage requires starting from scratch. New ships, new crews, new capital. The cycle bleeds companies dry before they build momentum. Then someone asks a dangerous question. What if we never liquidated? What if the company lived beyond any single voyage? March 20th, 1602. Representatives from 6 competing Dutch trading companies gather in The Hague, rivals forced by the government to merge into something unprecedented. They call it the Verenigde Oost-Indische Compagnie, the United East India Company, the VOC. The charter grants powers no merchant has ever wielded: the right to wage war, the authority to sign treaties, permission to establish colonies. For 21 years, later extended indefinitely, the VOC holds absolute monopoly over Dutch trade east of the Cape of Good Hope and west of the Strait of Magellan. But the true revolution hides in the financial structure. The VOC raises 6.5 million guilders through public subscription. Citizens invest not in specific ships or single voyages, but in the company itself, permanent capital. The shares trade freely. Investors can sell to others without dissolving the venture. Profit comes not from liquidating after each expedition, but from dividends paid from ongoing operations. The Amsterdam Stock Exchange opens in 1611 to handle the trading volume. Humanity invents the stock market. Limited liability protects investors. If a VOC ship sinks, shareholders lose only their investment, not their homes, not their estates. Risk spreads across thousands of investors instead of crushing individuals. Capital flows into the company at scales previously impossible. Within a decade, the VOC operates 30 ships, then 50, then 100. Fleets sail with military escorts. Warehouses sprawl across Dutch ports. The company builds infrastructure that individual merchants could never afford. But owning shares means nothing without the goods to generate profits. The VOC faces a problem. Asian rulers control the spices. Local merchants set prices. Competition from Portuguese, English, and French traders drives up costs. The solution arrives in 1619 in the form of a ruthless administrator named Jan Pieterszoon Coen. Coen becomes Governor General of VOC operations in Asia. He stands in the ruins of Jayakarta, a Javanese port the company just conquered. Around him, Dutch soldiers build fortifications. He names the settlement Batavia. It will become the nerve center of a commercial empire. Coen writes to the directors in Amsterdam, "Your honors should know that trade in Asia must be conducted and maintained under the protection and favor of your honors' own weapons, and that those weapons must be paid for by the profits from trade. We cannot carry on trade without war, nor war without trade." Translation, we conquer or we fail. The English East India Company maintains trading posts through negotiation. The Portuguese rely on scattered forts and alliances with local rulers. Coen proposes total control, not diplomacy. Domination. His target? The Banda Islands, tiny specks in the Indonesian archipelago, 10 volcanic islands producing 100% of the world's nutmeg supply. Control Banda, control the global nutmeg trade, control the trade, name your price. Local leaders refuse VOC demands for exclusive contracts. They trade with English and Portuguese merchants. They resist Dutch interference in their sovereignty. Coen sails for Banda with a fleet of ships and 2,000 soldiers. May 1621. 13 VOC warships anchor off Banda Nera. Governor General Jan Pieterszoon Coen steps onto volcanic soil with an army at his back. 15,000 people live across the Banda Islands, farmers, traders, families who have cultivated nutmeg groves for generations. Coen gives them a choice that is not a choice: submit to VOC monopoly or face annihilation. The Bandanese choose resistance. Dutch soldiers sweep through the islands like a plague. They burn nutmeg groves to force surrender. They execute village leaders in mass hangings, 40 orang kaya, traditional chiefs, strung up as warnings. They hunt resistors through volcanic hills. Those who survive the initial assault face starvation as the VOC blockades supply routes. The company transports thousands to Java as slaves for the nutmeg plantations they will establish under Dutch control. Mortality rates among transported laborers reach 97%. Worked to death. Starved. Killed by tropical disease in forced labor camps. By the time Coen finishes, fewer than 1,000 Bandanese remain alive on their ancestral islands. 15,000 reduced to rubble and ghosts. The VOC imports Dutch colonists and Japanese mercenaries to work the nutmeg plantations under armed supervision. Total monopoly achieved through total annihilation. Nutmeg prices in Amsterdam soar 300% overnight. The VOC controls supply absolutely. They harvest, they ship, they sell. No competition, no negotiation. The company dictates terms to European markets desperate for spices that preserve food and mask the taste of spoiled meat. Coen writes to Amsterdam with cold satisfaction, "The islands are pacified, the trade is secured." The directors write back with promotions and bonuses. From Batavia, Coen builds the machinery of commercial domination. The VOC expands beyond nutmeg. Cloves from the Moluccas, pepper from Sumatra, cinnamon from Ceylon, tea from China, silk from Japan. The company establishes trading posts from Persia to Formosa. But the VOC does not simply trade, it conquers. Dutch forces seize Malacca from the Portuguese in 1641 after a 5-month siege. The gateway to the straits collapses under VOC cannons. Control of Malacca means control of shipping between the Indian Ocean and the South China Sea. Every merchant vessel pays tribute or faces Dutch warships. The company builds fortresses across Indonesia, permanent military installations staffed with 10,000 soldiers, not colonial governors reporting to The Hague, but company employees protecting corporate assets. The VOC wage wars against local sultanates that resist Dutch terms. They sign treaties that reduce kingdoms to client states. In Ceylon, VOC forces push out the Portuguese and establish cinnamon monopolies enforced by martial law. In India, they maintain trading posts that rival English operations. In Japan, they secure exclusive European trading rights after proving their loyalty during the Shimabara Rebellion, Dutch ships bombarding Japanese Christian rebels to curry favor with the Tokugawa shogunate. The VOC becomes a sovereign power that operates as a business. It maintains diplomatic relations with the Mughal Empire, the Qing dynasty, and dozens of smaller states. It wages naval battles against European competitors. It administers justice in territories it controls, executing criminals and settling disputes under VOC law. By 1650, the company operates more than 150 merchant ships and 40 warships. 50,000 employees spread across 3 continents. Warehouses in Amsterdam overflow with Asian goods that transform European markets. Shareholders watch their investments multiply. Share prices climb 1,200% between 1602 and 1650. Fortunes built on dividends funded by Indonesian blood. The year 1669 marks the peak. VOC accountants calculate annual dividends of 40%, 40% returns on invested capital. Shareholders receive nearly half their investment back every single year while retaining their shares. The Amsterdam Stock Exchange erupts in buying frenzies. Everyone wants VOC paper. Merchants, nobles, widows investing their late husbands' estates. The shares become the safest, most profitable investment in Europe. Dividend ceremonies in Amsterdam become grand spectacles. Company directors announce payouts in marble halls. Shareholders collect florins and guilders in velvet pouches. The wealth flows from Asian plantations through Batavia warehouses onto Amsterdam streets, paved with commercial triumph. But the accountants in VOC headquarters know a secret the shareholders cannot see. The 40% dividend exceeds actual profit margins by 32%. The company earns roughly 8% profit on trade operations. 8%, not 40%. The difference comes from borrowed money. The VOC takes loans from Dutch banks. It issues bonds. It borrows against future profits. Then it pays dividends from that borrowed capital to maintain share prices and investor confidence. The directors understand the trap they have built. If they reduce dividends, shareholders panic. Share prices collapse. The company loses access to capital markets. They cannot fund operations without share sales and bond offerings. So they maintain the illusion. They borrow more to pay dividends. They falsify accounting to hide the debt accumulation. By 1670, the VOC owes 30 million guilders, nearly 5 times its founding capital. But the ships still sail. The spices still flow. The empire still expands. Nobody questions the machine while it prints money. The year 1730. VOC headquarters in Amsterdam resembles a palace of prosperity. Mahogany furniture imported from Asian colonies fills director offices. Maps spanning entire walls display an empire stretching from the Cape of Good Hope to Nagasaki. Clerks in powdered wigs calculate dividends with quill pens that scratch numbers into leather-bound ledgers. The numbers tell a story the shareholders never read. Debt, 60 million guilders. The company owes 10 times its founding capital. Interest payments alone consume profits from entire trade seasons. The VOC borrows from Amsterdam banks to service debt from previous loans. It issues new bonds to pay interest on old bonds. The cycle accelerates like a wheel rolling downhill toward a cliff no one admits exists. Yet dividends continue. 15%, 12%. Still enough to keep shareholders satisfied. Still enough to maintain the illusion that the mighty VOC generates wealth rather than accumulating catastrophe. The directors face an impossible choice. Admit failure and watch the company collapse immediately, or maintain the deception and hope something changes before the inevitable arrives. They choose deception. Accounting tricks multiply like rats in a warehouse. Ships that should be scrapped remain on the books as assets. Cargo values get inflated before they sell. Asian administrators report fictitious profits while actual revenues decline. The company counts inventory at purchase price rather than market value, creating paper wealth that vanishes the moment anyone attempts to convert it to cash. The VOC pioneered corporate finance. Now it pioneers corporate fraud. While the Dutch company drowns in debt, British competitors surge forward. The English East India Company transforms from trading operation into territorial power. British forces defeat the Nawab of Bengal at the Battle of Plassey in 1757. Robert Clive secures control over Bengal's revenues, wealth that dwarfs anything the VOC extracts from Indonesia. The British do not merely trade, they conquer entire regions and tax them directly. The EIC becomes a state within a state, administering Bengal with its own army and bureaucracy. Revenue from Indian taxation funds further expansion. The model shifts from commercial monopoly to territorial empire. The VOC cannot match this transformation. Its charter restricts operations to trade and limited territorial control. The Dutch Republic lacks the military power to support massive colonial expansion while fighting European wars. The company remains trapped in an outdated model, defending expensive monopolies against competitors who have discovered more profitable strategies. In the spice trade itself, prices collapse. Nutmeg and cloves no longer command premium rates. European markets have diversified, new sources emerge. The monopoly that justified genocide in Banda dissolves as supply increases and demand stabilizes. The VOC holds islands it conquered at tremendous cost, but the strategic value has evaporated. Tea and coffee become the profitable commodities. China and the Middle East control those trades. The VOC cannot compete effectively against British operations that cultivate relationships the Dutch never developed. Market share bleeds away like water through cracked stone. In Batavia, VOC administrators live like princes while the company collapses around them. They build mansions with company funds. They maintain harems. They hold lavish banquets featuring imported European wines and Asian delicacies while warehouses sit half empty and soldiers go unpaid. The distance between Amsterdam and Indonesia creates perfect conditions for theft. Reports take months to arrive. By the time directors discover discrepancies, the administrators who created them have retired back to the Netherlands as wealthy men. Prosecution requires evidence that vanished into tropical humidity and creative bookkeeping. Private trade, officially forbidden but universally practiced, undermines company monopolies from within. VOC captains use company ships to transport goods for personal profit. Local factors purchase Asian goods at low prices and sell them through private channels at rates that undercut official VOC sales. Employees enrich themselves by sabotaging the organization that employs them. The company cannot stop the corruption without admitting its extent. Admitting the extent means revealing to shareholders that their dividends came from borrowed money while actual profits disappeared into the pockets of employees who gamed the system. So the directors say nothing. They issue stern memorandums demanding ethical conduct. They threaten prosecution that never materializes. They watch the empire disintegrate while maintaining public pretense that everything functions as intended. By 1750, VOC debt reaches 85 million guilders, 13 times the founding capital. The company owes more than most European nations. Interest payments consume revenue faster than trade generates it. The debt compounds annually. The weight becomes unsurvivable. 3 structural flaws doom the VOC beyond any hope of recovery. First, the monopoly paradox. High prices justified through monopoly control invite competition and smuggling. Military enforcement costs escalate to defend the monopoly. Eventually, enforcement costs exceed monopoly profits. The company spends more protecting its dominance than it earns from that dominance. The logic becomes circular and fatal. Second, the dividend trap. Shareholders expect consistent returns. Reducing dividends triggers panic selling. Share price collapse destroys the company's ability to raise capital through equity offerings, so the company maintains dividends through borrowing. But borrowed money requires interest payments that exceed the dividends saved. The trap tightens with each passing year. Third, the distance problem. 6 months separate decision-makers in Amsterdam from operations in Asia. Information arrives outdated. Directors cannot respond to crises in real time. Local administrators operate independently with minimal oversight. The principal-agent problem becomes insurmountable when principals and agents live on opposite sides of the planet in an age of sale. These mechanisms interlock like gears in a machine designed to destroy itself. Modern corporations will repeat every single one of these mistakes over the next 3 centuries. Different names, same fundamental failures. The Fourth Anglo-Dutch War erupts in 1780. British naval forces blockade Dutch ports and attack VOC shipping across Asian waters. The company lacks the military resources to defend its trade routes. Ships hide in harbors. Cargo rots. Revenue streams dry up completely. The war exposes what decades of accounting fraud concealed. The VOC is bankrupt. Share prices collapse 95%. Investors who believed they owned pieces of an empire discover they own shares in a corpse. Bondholders demand payment the company cannot provide. Creditors circle like vultures over a dying animal. The Dutch government faces a choice. Let the VOC fail and destroy the national economy, or nationalize the company and absorb its catastrophic debts. They choose nationalization. In 1796, the Batavian Republic, successor to the Dutch Republic after French invasion, takes control of VOC assets and liabilities. Government accountants examine the books with fresh eyes unclouded by years of institutional denial. The true scope of the disaster reveals itself. Debt, 134 million guilders, 20 times the founding capital. The company owes more than the entire annual revenue of the Dutch state. The liabilities exceed any possibility of repayment. The VOC has operated as a zombie for decades, technically alive but functionally dead, sustained only through increasingly desperate borrowing. Recovery is impossible. Liquidation becomes inevitable. The government prepares the paperwork to dissolve history's first megacorporation. December 31st, 1799, the Dutch East India Company ceases to exist. No grand ceremony marks the occasion, no speeches in marble halls, no farewell from directors who spent decades maintaining illusions of prosperity. A clerk named Johannes Petrus signs the final liquidation documents in a quiet office while Amsterdam sleeps through the turn of the century. 250 years of operations end with a signature on paper. The Batavian Republic seizes all VOC assets, the ships, the warehouses, the forts scattered across Indonesia, the trading posts from Persia to Japan. The accountants tally the remains of what was once the mightiest commercial empire on earth. The shareholders receive nothing. Men who invested family fortunes discover their shares are worthless. Widows who relied on VOC dividends for survival face destitution. Pension funds built on VOC bonds collapse. The liquidation destroys wealth across every social class in the Netherlands. Merchants, nobles, common citizens who believed the company would endure forever. The debt, 134 million guilders, transfers to the Dutch state. Taxpayers will spend the next century paying for mistakes made by directors who died wealthy and unpunished. The colonial territories do not gain freedom. The Batavian Republic simply replaces corporate administration with government control. Indonesia remains a colony for another 150 years. The plantations continue operating. The forced labor persists. The extraction of resources proceeds under a different flag but identical brutality. The VOC dies. The empire it built survives under new management. British forces occupy Dutch colonial possessions during the Napoleonic Wars. They returned some territories after 1815, but the balance of power has shifted permanently. The English East India Company dominates Asian trade. British colonial administration in India generates revenues that dwarf anything the Dutch ever achieved. The Netherlands shrinks from global power to regional player. The Golden Age ends not with conquest or military defeat, but with corporate bankruptcy. An empire built on shares and ledgers dissolves when the accounting no longer supports the fiction. The warehouses in Amsterdam that once overflowed with Asian spices sit empty. The stock exchange that pioneered share trading continues operating, but VOC certificates become collectors' curiosities rather than investments. The ships rot in harbors or get sold for scrap. The fortresses in Indonesia crumble under tropical rain and Dutch government neglect. History forgets quickly. Within a generation, the VOC becomes a cautionary tale told to warn against unchecked corporate power. Then even the warnings fade as new companies rise with new schemes that repeat the same fundamental mistakes. The mechanisms that destroyed the VOC do not disappear. They hibernate, waiting for the next generation of entrepreneurs and investors to rediscover them. The Banda Islands remain depopulated for decades. Nutmeg grows wild on volcanic soil stained with the blood of 15,000 murdered people. Nature reclaims the plantations. The groves that justify genocide produce fruit that no one harvests because the monopoly that made them valuable no longer exists. The survivors and descendants of VOC exploitation receive no compensation, no apologies, no acknowledgement that the wealth of Amsterdam was built on Indonesian corpses. The Dutch state inherits the assets but denies responsibility for the atrocities committed under corporate charter. The ledgers that documented 2 centuries of trade, conquest, and fraud get archived in government warehouses. Historians will spend the next 200 years piecing together the true story from documents designed to obscure rather than reveal. The final accounting shows the mathematical certainty of the collapse. The VOC paid out more in dividends over 2 centuries than it earned in actual profits. The difference came from debt that compounded faster than trade could service it. The company borrowed from the future until the future arrived and demanded payment. No conspiracy destroyed the VOC. No external enemy dealt the killing blow. The company murdered itself through mechanisms embedded in its structure from the beginning. The same innovations that made it powerful, permanent capital, limited liability, tradable shares, created incentives for short-term thinking that sacrificed long-term survival. The directors who paid excessive dividends to maintain share prices acted rationally within the incentive structure. The administrators who looted operations in Asia responded logically to impossible oversight. The shareholders who demanded consistent returns behaved exactly as investors always behave. Every actor made individually reasonable choices that collectively guaranteed catastrophe. The VOC proved that corporations like nations can dominate the world and still collapse. The 2.5 centuries of success do not ensure survival. That empires built on exploitation contain the seeds of their own destruction. That debt accumulates silently until it becomes unsurvivable. The lesson goes unlearned. The Dutch East India Company invented modern capitalism. It pioneered the joint stock corporation, the stock market, limited liability, and dividend expectations. Every major corporation today descends from innovations the VOC introduced in 1602. But the VOC also invented every major form of corporate fraud and collapse, paying dividends from borrowed money instead of profits. Enron did this in 2001. Lehman Brothers did this in 2008. WeWork attempted it in 2019. The mechanism remains identical. Create the illusion of profitability while accumulating unsustainable debt. Using accounting tricks to hide declining asset values. Every financial crisis features companies that mark assets at purchase price rather than market value. The VOC invented this practice 400 years ago. Modern corporations perfect it with more sophisticated terminology but identical intent, exploiting geographic distance to enable corruption. Multinational corporations still struggle with oversight of foreign operations. The distance today is cultural and regulatory rather than oceanic, but the principal agent problem remains unsolved. Managers enrich themselves at shareholder expense when monitoring becomes impossible, defending monopolies at escalating cost until enforcement expenses exceed monopoly profits. Modern tech companies spend billions on lobbying, litigation, and regulatory capture to maintain market dominance. The mathematics work until they do not. The VOC demonstrated this 3 centuries before antitrust law existed. The company that invented shareholder capitalism also proved its fundamental instability. Quarterly earnings pressure, short-term thinking, debt-fueled growth. These are not modern problems. They are original features of the corporate model the VOC created. Today, corporations operate with market capitalizations that dwarf the VOC at its peak. Apple, Microsoft, Amazon, Saudi Aramco, trillion-dollar valuations that make the Dutch company's $780 billion equivalent seem quaint. But the mechanisms of collapse remain unchanged. Debt accumulates. Competition erodes monopolies. Distance enables corruption. Short-term incentives destroy long-term value. The names change. The mathematics do not. The VOC lasted 250 years before collapse. How long will modern megacorporations survive? The question is not whether they will fail, but when and how catastrophically. The shareholders of 1799 who lost everything believed their investments were safe. The company had survived for nearly 2 centuries. It dominated global trade. It seemed too big to fail. They learned what every investor eventually learns. Nothing is too big to fail. Everything built by humans can be destroyed by humans. Empires of steel collapse. Empires of paper burn faster. The VOC died on the last day of the 18th century, but its ghost haunts every boardroom, every stock exchange, every corporation that believes dominance equals permanence. The ledgers are closed. The ships have sailed their final voyages. The company exists now only in archives and history books, but the mechanisms live on, waiting for the next generation to rediscover them and repeat the cycle. The Dutch East India Company became history's first megacorporation by inventing modern capitalism. It collapsed by proving that invention came with an expiration date no one bothered to read.